So hopefully you can see us. We are live with Jesse Moreno. He is an amazing CPA that has been helping me and my clients. So I figure it is tax season. Maybe there is some information that you need that he can give us. Jesse, do you want to talk a little bit about why should people listen to you?
Well, you want to save money on taxes, and you do want to maximize the dollar you earn. It's your hard-earned money, and you definitely want to pay the least amount as legally possible. So, talking to me would help you get to that goal, you know?
So he says, right? How long have you been a CPA?
I've been a CPA since 2002.
2002?
Yes.
Okay.
Definitely.
So what are some of the most common questions in this new tax season that are coming up for you?
For me is, are we going to get another round of stimulus, which at this point we don't know yet, but people definitely, when they have a new child for the year, they did not get any money last year, but with their tax returns, this filing, they will get an adjustment on their tax return. They will get the difference. What they could have gotten last year, they didn't get, they'll get it now. So that's one of the most popular questions right now that I'm getting. Aside from that is, when is tax season going to start? The IRS pushed the tax season start date till February 12th, but we're preparing returns now, and we're stockpiling them for submission.
Carla's also asking, do they have to claim the stimulus check?
It's not a taxable item, but if you got less than the full amount, and if you qualify for more, you could get the difference with your tax return. So if you're single and your stimulus check was $1,200, the total amount, but you only received $1,000, there's $200 still there that you could potentially claim for on your tax return. So it's important to verify what you got, and that way, if you qualify for more, it gets applied to your return.
Got it. Let's see. Borrowers are thinking of purchasing a home. What are some of those incentives of buying a home? And is there anything new in this tax season?
Well, the tax code didn't really change. There's adjustments to cost of inflation, cost of living adjustments. So deductions have been expanded, but it's the same law. The law hasn't changed, but there is, the stimulus, that people got. Those are all different things. That's the hot topic at this point. But with regard to a new homeowner, your mortgage interest statement, that's what you paid in mortgage interest, that's deductible. The points you paid on the acquisition of the property, that's deductible. Property taxes, your DMV fees, all that stuff hasn't changed. It's still deductible. There's, what did change for a lot of people, the self-employed or the employees that do work, their employee expenses, that's no longer deductible with the IRS. So that's been people still trying to get used to the fact that they can't write off their union dues or their home office if they're an employee. And so that's still a topic.
When you say if they're an employee, meaning if they're W-2 employees?
If they're a W-2 employee, correct, yes.
Okay, so basically you have your W-2 and that's about it.
Yes. Yes.
But if you're self-employed, it's different.
Self-employed, you still have the option of having a home office. You have the full spectrum of deductions still for that business. So yeah, self-employed individuals, they're still allowed to take those deductions, yes.
Got it. I get personally a lot of questions on the 1031 exchange.
Okay.
Can you brief us on that? What is a 1031 exchange and who does that apply to?
Okay, well, 1035 exchange is one of those wonderful loopholes in our tax law. I do a few clients a year, so I am familiar with the situation. The 1031 exchange is when you trade a real estate investment property for another real estate investment property, right? So it cannot be your residence. It's not your personal residence for another personal residence. Those are different rules. For a like-kind exchange is a rental for another rental, or a rental for a farm. It has to be an investment in real estate. So it's a mechanism to avoid paying taxes on your current property, and you transfer the basis to the property you're acquiring. And so you're deferring the gain or the taxes on the sale because you're replacing that property with another property. So that's pretty much in a nutshell what it is. You can have an 8-hour seminar on like-kind exchanges, but for investors, it's a good tool to have to avoid paying taxes now and deferring it to a later property or later sale.
So as long as you continue to put that money from one investment into another investment, you don't pay taxes.
Correct. Yeah, you pay taxes only if you receive boot, which is basically if you receive any cash, or you did not buy a bigger property or more expensive property. There is taxes on the portion that you do, collect from it. But but the purpose for most of my clients in particular is investing from a big, from a 4 unit property to a 10 unit property, from $1 million property to a $2 million property. So they're upsizing, and the like-kind exchange is the vehicle that they use in these situations to avoid taxes on their current property, and they move their basis to the next one. So
what happens when somebody buys a property and so it's their primary residence, and then they sell it?
Okay.
Do they pay taxes on that? Let's just say that they're not going to purchase right now because maybe they're waiting for the market to
stabilize.
I'm
sorry to cut you off. But,
No, yeah, but which we know properties are not going to go down. But for those that are saving the money from the sale of their primary residence, do they have to pay taxes on that?
Not necessarily. There's rules. One of our code section 121 is a nice item in our tax code that allows homeowners to exclude up to $250,000 of capital gain on their residence. If you're single, if you're married, it's $500,000. There's rules to get there. It has to be your residence 2 out of the last 5 years. So if 2 out of the last 5 years, if that requirement is met and you sell your property at a profit, if you're single, $250,000 of gain could be excluded from taxes. If you make more than that, then the excess, you start paying taxes on that at the long-term capital gain rates. It starts at 0 and it just gradually goes up. It could be 15%, 20%, depending on your client's total income. But for the most part, if you buy a house today, keep it for 2 years, live in it for 2 years, and if your profit's under $250,000, no tax.
Profit. That's net profit, right?
Profit, yeah. So you bought it for $200, you sold it for $500. That's $300,000 of profit. If you're single, $250 of that $300,000 profit is tax free. You only pay taxes on $50.
Oh wow.
Right.
Okay.
So, and if you're married, $500,000.
$500,000.
Yes.
Got it. There's another question. It says the IRS moved the starting date to file taxes on February 11th. Is April 15th the last day to file, or are they moving that too?
I wish I knew. Currently, that's the deadline, April 15th. Now, anything could happen. Last year, we're in mid-March, and they pushed it to July 15th, right? So the government can make that call and halfway through April, extended to July. At this point, as far as we know, it starts February 12th. That's filing season commencement, and it closes April 15th. You can still file extensions if you're not ready, and the extension's good through October 15th for most individuals. And so if anybody's still gathering their documentation, you're not ready, you're scared about still, the environment that we're living in, we can do an extension. You can email us, call us. We can do an extension for you, and that buys you an additional 6 months of time, and regardless if the government extends or not. So
You still have 6 months as long as you do an extension.
Correct. We can do it all the way through October 15th.
Got it. But they have to file the extension before April 15th.
If the government extends the deadline again, like say they move it to July 15th once more, then we have to file the extension by July 15th.
Got it.
But it still only gives you through October 15th.
Got it. Okay. And is there a fee to extend?
No, there's no fee. I don't charge a fee for extensions.
He doesn't.
We could. It depends. If we have to do a calculation to estimate a tax bill, for example, someone who normally owes every year and they know that they're going to owe $5,000 or $1,000 and they want to submit a payment with the extension, then we can calculate the extension. That would probably take a quick phone call or, a small consultation to come up with the right number. And we could do an extension, pay the IRS, and, extend.
And extend. Okay. What are some of the documents? Somebody just bought a house. What are the documents that they need to bring to you?
Okay, someone just bought a house. They're ready for their taxes. I asked for their closing statement. Most loan officers or realtors provide that, a copy to their clients. I'm sure you provide a copy to your clients. So your HUD closing statement shows a breakout of purchase price, purchase date, and if there's any deductible components from that statement alone, we'll take those. Your 1098 mortgage interest statement, that's the summary of what you paid in interest for the year. If you had multiple loans because you refinanced, or your mortgage changed, servicers, then you might have more than one 1098. So that's important. Property taxes, what you paid in property taxes on your home. Those are the two new items for you as a new homeowner. That mortgage statement should have it if you have your accounts impounded. But if you don't, if you make your payments yourself, your property tax bill and your supplemental taxes, because usually supplemental taxes are one of those items that people tend to forget come tax season.
Mm-hmm.
They forget that they're due, or they forget to pay them, or if they pay them, they forget to bring me the bill. So it's the supplemental tax bill. That's one.
Make sure you bring that.
Yes,
It says, would you please explain how buying a house and paying for a loan can help a person to deduct taxes up to 20% from the loan payment?
I don't know if that I understand the question, but when you do have a loan, you get a loan for a mortgage or personal residence. What's deductible is your mortgage interest. So the mortgage interest, the points paid on your home, the property
so your
taxes,
closing costs, that would be your closing costs?
Yeah, well, not the entire closing costs. If it's your personal residence, closing costs are not deductible, but origination fees on the loan is. So the points, because you're prepaying interest, is that's the reason why points are deductible. But when we add up all your itemized deductions, let's say you're single and the standard deduction that every single individual is $12,400, but your mortgage interest, your donations, your property taxes, your personal write-offs are $25,000, you take your $25,000 of a deduction instead of the $12,400 that you normally get. Now, the tax savings is based on your tax bracket. So if you're in the 20% tax bracket, you save 20% of every dollar that you get a write-off for. California, if you're in the 9% bracket, you save 9%. So you do get tax savings on the excess of the standard deduction for having your mortgage and your property taxes. Now, a 20% credit, there are credits out there for homeowners. The most popular one nowadays is the solar credit. So if you put solar panels on your residence, that got extended 2 more years, so you get 26% credit dollar for dollar if you install a new solar panels. So if you spend $10,000, you get $2,600 of a tax credit, and that is dollar for dollar. So if the question was more in line to those energy efficiency credits that was extended, then I believe that might be the question that we got here, is what kind of improvements can you do on your home to get these credits? It's 26%. And solar power is the number one item here in Southern California at this point.
Oh, good information. Yeah. We have another question. Patty Rodriguez, thank you for joining. She says, will buying an investment home help as a tax shelter?
Yes. Well, if you buy an investment home, it's a rental property. Yes, it's treated as a business. So if you buy it and don't do anything with it, it's probably not going to be much of a tax write-off. But if you do rent it out, and if you do have operating expenses that go with it, you do potentially get a write-off. There's some income thresholds to qualify. It's not automatic, but yes, real estate's a good way of sheltering income, and buy rentals and buy investment properties. If you can do it, go for it.
We agree. Thank you so much.
No, you're welcome. Thank you.
And thank you so much for joining. We'll be giving you more tips soon.
Yes.
Bye.
Thank you. Bye.